You know what's the most uncomfortable truth in economics? The rich don't just stay rich, they get richer, faster, every single year. And it has almost nothing to do with what you think. It's not inheritance, it's not corruption. It's not even luck, although luck plays a role nobody wants to admit. According to a 25-year longitudinal study from the National Bureau of Economic Research, the top 10% of wealth holders don't just earn more money, they earn more per dollar they already have. Their money literally works harder than yours does, not because they have access to secret investments, but because of how their brains process risk, time, and opportunity. And here's the part that should genuinely bother you. The psychological patterns that allow wealth to compound aren't hidden behind some country club paywall. They're observable, documented, and replicable. But almost nobody teaches them because they're boring, counterintuitive, and deeply unsexy. They don't fit in a TikTok. They don't make good headlines. And they certainly don't sell courses. Stay with me, because what I'm about to walk you through isn't some motivational speech about thinking and growing rich. It's the actual cognitive architecture that separates people whose wealth compounds from people whose wealth stagnates. And more importantly, it's what you can extract from that architecture and install into your own financial life, starting this week, regardless of your income level. Let's start with the mechanism that drives everything else: the wealth compound loop. Most people think wealth grows linearly. You earn, you save, you invest, your pile gets bigger. Simple math. But research from MIT's Sloan School of Management reveals that wealth actually grows through reinforcing feedback loops, where each advantage creates the conditions for the next advantage. Here's what that looks like in practice. A person with $500,000 in investable assets gets access to investment vehicles that someone with $50,000 simply cannot touch. Private equity funds, venture capital allocations, commercial real estate syndications, all of them have minimum investment thresholds that effectively create a velvet rope around the highest returning asset classes. A 2023 analysis from Cambridge Associates found that private equity has outperformed public markets by an average of 3 to 4 percentage points annually over the last 20 years. That gap, compounded over decades, creates an absurd divergence in outcomes. But here's the part nobody talks about. The access isn't really the advantage. The advantage is what access does to your psychology. When you're investing in something that requires a $250,000 minimum, you're not checking your phone every day to see if it went up or down. You can't. These investments are illiquid by design. You're locked in for 7 to 10 years. And that forced patience, that inability to panic sell, is worth more than the higher returns themselves. Research from Dalbar, the financial research firm that tracks investor behavior, found that the average equity investor underperformed the S&P 500 by nearly 3% annually over a 30-year period. Not because they picked bad funds, because they bought and sold at the wrong times. Driven by emotion, the wealthy investor in a locked-up private fund didn't have that option. Their money compounded uninterrupted because they literally couldn't interfere with it. This is the first mindset extraction. The rich benefit from forced patience. But you don't need a $250,000 minimum to create the same effect. You need systems that make it psychologically difficult to touch your investments. Automated contributions into index funds. Retirement accounts with withdrawal penalties. Anything that puts friction between your emotions and your money, because the behavioral data is unambiguous. The less you touch your investments, the more they grow. Not because of any magical strategy, because you stopped getting in your own way. The ownership mindset. Here's the second pattern, and it's the one that creates the widest gap between wealthy people and everyone else. Rich people buy assets. Everyone else buys stuff. That sounds like a bumper sticker, but the psychology underneath it is genuinely fascinating. Research from the University of Chicago's Booth School of Business found that wealthy individuals consistently frame purchases through what economists call an opportunity cost lens. When they look at a $40,000 car, They don't just see a car. They see $40,000 that could be generating returns elsewhere. They calculate what that money would become in 10, 20, 30 years if invested instead. And here's the crucial distinction. They don't always choose the investment. Sometimes they buy the car, but they make the decision consciously knowing exactly what they're trading. Most people never run that calculation. They see the car, they want the car, they finance the car. The opportunity cost never enters the equation because their brain never learned to frame purchases that way. A 2021 study published in the Journal of Financial Economics found that households in the top quintile of wealth allocated nearly 4 times more of their income toward appreciating assets, stocks, real estate, business equity, compared to households in the middle quintile. Even when controlling for income differences, it wasn't that they earned dramatically more. They directed their money differently. But it goes deeper than just buying stocks instead of stuff. Wealthy people tend to think like owners across every domain of their lives. They negotiate, they ask for equity. They look at every expense and ask, is there a way to turn this from a cost into an investment? A behavioral economist at Princeton described it this way. Middle-class psychology treats money as a medium of exchange. You earn it. You trade it for things you need or want. Wealthy psychology treats money as a productive resource. You deploy it, you expect it to generate more of itself. Here's how you extract this. Before any purchase above $100, run a simple calculation. What would this money become in 10 years if invested at 7% return instead? A $1,000 purchase today is roughly $2,000 you won't have in a decade. That doesn't mean you never buy anything. It means you make every spending decision with full awareness of what you're actually trading. Over time, your brain starts running this calculation automatically. And that automatic calculation is the ownership mindset operating in the background. The relationship between risk tolerance and information asymmetry. This is the pattern that most personal finance content completely ignores because it's uncomfortable. Wealthy people take more risk, but not the way you think. Research from Yale's School of Management found that high net worth individuals don't have higher risk tolerance in the traditional psychological sense. They don't enjoy gambling more. They don't get a thrill from uncertainty. What they have is lower perceived risk because they invest heavily in information before they invest money. The average person hears invest in real estate and imagines everything that could go wrong. The property could lose value, tenants could destroy it, the market could crash. They're making a decision with incomplete information, so their brain fills the gaps with worst-case scenarios. That's not irrational. That's your threat detection system working exactly as designed. But a wealthy investor considering the same real estate deal has spent weeks, sometimes months, studying the market, the demographics, the rental yield history, the comparable sales, the zoning changes, the infrastructure plans. By the time they commit capital, they've reduced the information gap to the point where the investment feels almost boring. The risk hasn't disappeared, but their understanding of it has transformed it from a terrifying unknown into a calculated probability. A study from the London School of Economics confirmed this pattern across asset classes. Wealthy investors didn't avoid risk. They converted uncertainty into calculated risk through information acquisition. And calculated risk, by definition, isn't really that risky. This is the extraction. You probably can't afford to lose $100,000 on a bad investment, but you can afford to spend 50 hours learning about an asset class before you put $5,000 into it. The wealthy don't have some genetic advantage in risk tolerance. They just do more homework. And that homework converts fear into confidence, which converts paralysis into action, which converts income into wealth. Every hour you spend understanding how index funds work, how real estate cash flow operates, how compound interest actually functions in practice, is an hour that reduces your perceived risk and increases your likelihood of actually investing instead of sitting on cash that inflation is quietly destroying. The psychology of multiple income streams. Here's a statistic that gets cited so often, it's become background noise. but the psychology behind it is worth examining. According to IRS data analysis, the average millionaire has 7 sources of income, not 7 jobs. 7 sources. Most people hear that and think, great, I need a side hustle. But that completely misses the psychological principle at work. Research from the University of Michigan on financial resilience found that individuals with diversified income sources didn't just earn more. They experienced significantly less financial anxiety regardless of their total income level. Why? Because diversification reduces what psychologists call catastrophic thinking, the tendency to imagine the worst possible outcome and treat it as probable. When you have one income source, losing it means losing everything. Your brain knows this. It's running that scenario constantly in the background. Whether you're conscious of it or not, that ambient anxiety shapes every financial decision you make. You play it safe. You don't invest aggressively. You hold too much cash because the possibility of losing your only income feels existentially threatening. But when you have 3, 4, 5 sources of income, losing any single one feels manageable. Your threat detection system downregulates. You sleep better. You think more clearly about long-term decisions. And ironically, that reduced anxiety makes you more likely to take the calculated risks that build wealth faster. Here's what the wealthy actually do. They build income streams that are progressively more passive. The first source is active, their job or business. The second might be semi-active, consulting, freelancing, a small side business. The third and beyond are increasingly passive, dividends, rental income, royalties, interest from bonds. The extraction is this. You don't need 7 income sources tomorrow. You need 1 additional source this year. And the psychology research is clear on where to start. Start with something that leverages skills you already have. The activation energy required to build a new income stream is dramatically lower when it's adjacent to existing competence. A teacher tutoring online, an accountant doing freelance bookkeeping, a writer creating digital content. The goal isn't to work 7 times harder. The goal is to reduce your dependence on any single source so that your brain stops running catastrophe simulations and starts running opportunity calculations instead. The long game bias. This is the one that separates generational wealth from temporary wealth, and it's almost entirely psychological. Wealthy people operate on longer time horizons than everyone else. Not slightly longer, dramatically longer. Research from the Harvard Kennedy School found that the time horizon of financial decision-making correlates more strongly with wealth accumulation than any other variable they measured, including income, education, and investment knowledge. The average American makes financial decisions on a 2 to 3 year horizon. Will I need this money in the next couple of years? The average wealthy individual operates on a 10 to 20 year horizon. Where will this money be in 2 decades? And here's why that gap matters so much. When your time horizon is short, every market dip feels like a crisis. Every economic disruption feels permanent. Every expense feels urgent. Your brain is processing financial information through a narrow window, and through that window, everything looks volatile and threatening. But when your time horizon is long, those same events look completely different. Market corrections are buying opportunities. Economic disruptions are temporary. Short-term expenses are irrelevant compared to long-term trajectory. You're watching the same movie as everyone else, but you're seeing different scenes because your frame is wider. Research from Vanguard spanning 90 years of market data showed that over any 20-year rolling period in the S&P 500, there has never been a negative return. Never. Not through the Great Depression, not through World War II, not through the 2008 financial crisis. The people who lost money during those periods were the ones operating on short time horizons who sold at the bottom. The people operating on long horizons just kept going. The extraction here is straightforward but psychologically demanding. Extend your planning horizon. When you make a financial decision, ask yourself what 10 years from now you would want. Not next month you. Not next year you. A decade from now, this single cognitive shift changes everything because it restructures which information your brain treats as signal versus noise. Short-term market movements become noise. Long-term trends become signal. And when you stop reacting to noise, your financial life gets dramatically quieter and dramatically more profitable. The network effect of wealth. Here's the final pattern, and it's the one nobody wants to talk about because it feels unfair. Wealthy people are surrounded by other wealthy people. And that proximity changes their psychology in ways that are measurable and significant. Research from sociologist Nicholas Christakis at Yale found that financial behaviors are socially contagious. Your likelihood of saving, investing, starting a business, or negotiating a raise increases significantly based on how many people in your immediate social network do those things. When wealthy people sit at dinner, they talk about deals, investments, market opportunities, tax strategies. Not because they're showing off, because that's the ambient conversation of their social environment. And that ambient conversation normalizes wealth-building behavior. When everyone around you invests, investing feels normal. When everyone around you negotiates, negotiating feels normal. When everyone around you thinks in decades, thinking in decades feels normal. The reverse is also true. If your social environment normalizes paycheck-to-paycheck living, consumer debt, and short-term thinking, those behaviors feel normal too. Not because you're weak, because you're human. And humans are social animals whose behaviors are shaped by proximity more than by intention. A study from the Federal Reserve Bank of Philadelphia found that individuals who joined investment clubs or financial literacy groups increased their savings rates by an average of 22% within the first year, even controlling for income. The knowledge wasn't the primary driver. The social normalization was. The extraction is this. You don't need rich friends. You need financially intentional friends. Join communities where people talk openly about money, investing, and building wealth. Online forums, local investment clubs, financial book clubs, even just one friend who's serious about building wealth. Because the ambient conversation of your social environment is programming your financial psychology whether you realize it or not. So let me bring all of this together. Because here's the real insight underneath everything I've just walked through. The rich don't get richer because of some secret playbook. They get richer because of 6 psychological patterns that compound just like their money does. Forced patience that prevents emotional interference. An ownership mindset that frames money as productive rather than expendable. Information acquisition that converts fear into calculated action. Income diversification that reduces ambient anxiety. Extended time horizons that filter out noise. And social environments that normalize wealth-building behavior. None of these require a high income to implement. None of them require connections or privilege or luck. They require understanding how your brain actually processes financial decisions and deliberately restructuring that processing. The wealthy didn't start with better brains. They ended up with better calibrated financial psychology, either through environment, experience, or intentional design. And the research is clear that you can build the same calibration deliberately. But here's the honest caveat that most content like this leaves out. These patterns take time to produce results. You won't feel wealthy next month. You might not feel it next year. The compound curve is flat for a long time before it goes exponential. And during that flat period, you'll feel like nothing is working, like the boring habits are pointless, like the people spending freely are having more fun. They might be right now. But the math doesn't care about right now. The math cares about trajectory. And trajectory is determined by the psychological patterns running in the background of every financial decision you make. You're watching this video right now. That means you're already thinking about this differently than most people. Most people will never examine the psychological architecture underneath their financial lives. They'll just keep running the default programming and wondering why the results don't change. Your default programming is being rewritten right now, in this moment, by the simple act of understanding these patterns. The question is whether you'll let that rewrite actually change your behavior, or whether you'll nod along, close the tab, and go back to the same patterns tomorrow. The difference between people who build wealth and people who don't isn't knowledge, it's implementation. And implementation starts with one pattern, practiced consistently, until it becomes automatic. Pick one. The forced patience of automated investing. The opportunity cost calculation before purchases. The 50 hours of learning before deploying capital. The one additional income stream. The extended time horizon. The intentional community. Just one. Make it boring. Make it automatic. And then come back and add another. Because wealth isn't built in moments of inspiration. It's built in the quiet, compounding repetition of patterns that most people are too impatient to maintain. And that patience, that willingness to let the compound curve do its work while everyone else chases shortcuts, that might be the most valuable thing you extract from how the rich actually think. If this changed how you're thinking about your financial psychology, drop a comment and tell me which pattern you're implementing first. And if you haven't subscribed yet, now's the time. Because understanding the systems underneath wealth isn't a one video education. It's an ongoing recalibration. And every video you watch here is another layer of that recalibration working in the background of your decisions. The rich aren't smarter. They're just running better software. And you're upgrading yours right now.